Hello everyone, I hope everyone's doing alright in this flash crash, bear market, whatever you call it, and a warm welcome back to another episode of the Baking Analyst channel. On this channel, we cover everything from economics to personal finance and cryptocurrencies with a focus on DeFi and yield farming as a wealth building tool. So if that sounds interesting to you, do consider subscribing to this channel and leaving a like. If you're completely new to the world of DeFi and you're wondering how on earth people are generating good sums of income every single day just by staking their pairs of cryptocurrencies on decentralized protocols, I actually have an online course that you can find on Skillshare. You can access it for free with a free trial of Skillshare at the link down below. Cancel anytime and it will come at no cost to you whatsoever. So with that shilling out the way, let's jump right into the content. So today we're going to be talking about inflation, the recent price action of cryptocurrencies, and if we are in a bear market, what to do about it. In this video, I'll be covering the economics of the situation as well as some strategies we can use to deal with this in the DeFi world, such as safe accumulation using a stablecoin strategy, as well as the use of what I like to call reduced volatility pairs. So this is probably the first time I've featured economics content on this channel. Well, it's never been more relevant than in this environment, and also I paid 6 figures to sit in lectures about this thing, so why not talk a bit about it and share what I know. So the first thing that we have going on today is inflation. Inflation was reading at 7% in December 2021, and of course we all know that CPI, or the consumer price index, is a blatant lie. It understates inflation because a lot of items within a basket of goods used to calculate the CPI are not products that we buy on a daily basis and that take up the large part of the budget shares of everyday people. The next point is what is often seen in the news. A lot of the time they mention that the US, for example, is near full employment. And now, is this really the case? Because we have trends like the Great Resignation. There are people who are retiring early and they're leaving the workforce. So we know that unemployment rate is really the ratio of unemployed people to the people who are actually playing a game or participating in the workforce. So if people were to retire early or they were to resign and choose to work in the informal economy, then we are not going to see this register as part of the labor force, and that could skew figures and give a false reading of the true economic situation that we are supposedly near full employment. And then we have the Fed. You know, the saying goes, don't fight the Fed, right? Essentially what you need to know is if interest rates go up, demand goes down because it becomes more expensive to borrow. Companies can't invest as much in infrastructure and capital. And if rates go up too far, that could strangle the recovery of the economy. If the rates go down, on the other hand, or stay low, then we have the hyperinflation risk because the Fed has been printing a lot of money. And then we have another issue, right? If the economy really isn't doing as well as the indicators make it look, then there is a risk of stagflation. Essentially, stagflation is a period of low to no growth and high inflation rates. So while many investment firms think that stagflation in 2022 is highly unlikely, if the Fed goes too hawkish or raises rates by too far, in theory, that could reduce growth to the extent that we run into stagflation. This is not as likely in the US, which is a lot more tech heavy and has companies that invest in increasing productivity per worker. However, it is likely more probable elsewhere, such as here in the UK, where we have been seeing low productivity growth, maybe other countries in Europe as well. So stagflation generally is not very good for the market. So what can we do? First, let's look at our investment universe. So we have cash, which sounds stable, but is probably undesirable to hold everything in cash right now. You're losing real purchasing power at 7% per year. Bonds, they are less volatile than stocks, but as you can see, if the Fed stops buying back treasury bonds, the prices of these bonds are going to fall. You're going to lose in capital terms. Your yield might go up, but the thing is, even if yield goes up to like 2 or 3% and inflation is at 7%, you are still losing about 5% per year in real terms. And you have stocks. Well, this is a complex one because if rates go up, that is likely to not be so good for tech stocks, whose valuations are based on the present value of future earnings. So if interest rate goes up, essentially the discount rate goes up, and therefore the present value of all future earnings are likely to go down. And then another thing we have in our investment universe is crypto, just hodling a Bitcoin. And supposedly people have argued that Bitcoin, is a hedge against inflation. It has a set supply. However, in recent times, we have seen quite obviously that crypto is seen as a risk-on asset. Crypto follows stocks. Not too great, as we've seen in the past few days. Finally, DeFi solutions. So this is what we'll be looking at. And before we go on to the strategies, ask yourself the question, has your thesis changed at all on whatever coin that you're buying? Whether it is a hedge against inflation, increasing mistrust in centralized authority, or the macro trend of Web 3.0, that is a question only you can answer. So let's move on to talk about our first strategy in the DeFi universe. This is called safe accumulation, which is essentially a stablecoin coin strategy, in which, let's say you have an additional amount of money that you want to invest, but you're also afraid of losing your initial principal. So what you can do is you can put them into pure stablecoin pairs, and you use the yield that you earn from these pools in order to accumulate more of the crypto that you want to hold in the long term. You're protecting your initial capital, but you're also accumulating more coins while prices are low. And essentially what you'll be doing is playing with house money. So this definitely does seem like a viable strategy for the more risk averse. Cronos, for example, has currently boosted their yields on all their pools, as you can see. What we're interested in under this strategy is the pure stable pools, which are these three over here. Currently, the yields are sitting at 54%, 47%, 68%, so not bad at all if you're risk averse. These do sound like pretty promising options. And the other strategy, if your thesis on a particular coin or crypto in general hasn't changed, and you would still like some exposure to crypto with lowered volatility, you can choose to take your fresh capital and go for a reduced volatility yield farm pair. And this includes things like CRO, USDC, Glimmer, USDC, etc. On one hand, you do lose out on the upside because there's less upside during recovery. This is commonly an argument against yield farming as compared to hodling. Yes, there's a possibility that by hodling a larger amount, instead of splitting half of it into USDC, for example, you will get more upside during an upswing. However, the converse is also true, right? We don't often look at the downsides when we're trying to argue our case for hodling, for example, but in this case, with a reduced volatility pair, there will also be less downside risk during capitulation. Let's have a look at this nice little graphic over here on reduced volatility pairs. Essentially, what you need to understand is that when you do this, your exposure to the unstable coin, in this case CRO, is limited to basically 50% of your portfolio initially. Now, let's say CRO tanks, which is pretty much what could happen in a bear market. And a simplified explanation for what an AMM does in such a situation is that it always rebalances the pool such that half of the value of the pool is held in one coin and half of the value of the pool is held in the other. So in this case, you can think of it as USDC being sold off to purchase CRO, and you end up with this new portfolio, which yes, is slightly down. However, when you compare it to hodling the entire amount in CRO to begin with, then you realize that you have lost less. So I hope this functions as a simple explanation to why it might make sense going into CRO USDC, for example, and make impermanent loss work for you in bear markets, rather than be afraid of impermanent loss simply because it sounds scary. If you're in a Cronos ecosystem, as mentioned earlier, Cronos has boosted yields last week, and currently their reduced volatility pairs such as CRO USDC are doing 172%. The other one that is a bit more insane is actually on Moonbeam. So Moonbeam is a parachain of Polkadot. They just launched slightly over a week ago, so very new project. They're likely to be underrated and overlooked, especially during a time where there's a lot of fear in the crypto market. People are just trying to get out. So Moonbeam has Glimmer or GLMR as its gas token, and as we can see, this gas token, when paired with USDC, forms a reduced volatility pool. And currently, the APRs are 391% or up to 404%, which is insane, to be honest. And that is especially given that you have your total value locked in each pool being in excess of $1 million. So these APRs are actually pretty difficult to dilute, in my opinion. In terms of gas fees, the fees on Glimmer are pretty similar to CRO. It's not going to be like zero transaction fees, but definitely something to look into. I'll go through a separate video looking into Moonbeam in detail because this is a pretty interesting development that might be overlooked at the moment, but is something that you wouldn't want to miss. So I hope this video has been interesting and informative. If you liked it, do leave a like, and if you like more of this content, please consider subscribing to the channel. And with that said, thanks for watching, and I'll see you in the next one.